Do you want to keep more of your pension or not? If you want to keep more of your OAS, then watch this video until the very end and I'll share 7 tips that'll help you keep more of your money. Otherwise, I'll go to your house and claw it all back myself. Hey, I'm Hervin. I'm your money sidekick. I'm a fee-for-service financial planner here in Calgary, so I walk my clients through this stuff all the time. If you follow these tips, you could actually save a lot of money, maybe even tens of thousands of dollars in clawback mitigation. But before we dive in, I need to tell you something important. Planning ahead and thinking about how much money you'll really need to retire is super key to making these tips work like magic. There's another thing. Getting the OAS and maximizing it, it's good, right? Like it's good money. It's money from the government. At least that's the treatment of it for most people. But getting that OAS cash isn't the ultimate goal. What really matters is having enough money to enjoy your retirement the way that you want. Focusing too much on the OAS clawback could actually mess up your taxes or other investments, so I want to make sure that that caveat is there. It's like trying too hard not to spend money and you end up spending more in the end. Think about what you'll need first. Think about what you'll need your money for in retirement. Maybe you've dreamt of traveling to amazing places that you want to get to as a bucket list, or maybe you want to help family members get through big events, big milestones like weddings, getting through school, or buying their first home. Knowing when these big ticket items have to be covered will help you create a plan. It'll help you figure out how much to take from your savings without hitting the OAS clawback limit. So let's move on to this. Tip number 1, share your income with your spouse. Split your income with your spouse. It's her money anyways. So splitting your income with your spouse can actually be a game changer, but it needs some planning, especially with the savings end. Savings that aren't in retirement accounts need to be managed properly, but it's worth it. If you do it right, you can both declare a lot of income and still get full old age security. Remember that the current OAS clawback threshold is $90,997. This means that if you and your spouse can elect to split your income as close to perfect as possible, you can have $180,000 of income and still get the full old age security. Of course, it's not likely that you can split perfectly, but here's a few things that you can consider to get it as close to that as possible. You can elect to split pension income like RRSP, defined benefits, and other qualifying income in this list. You can also use a spousal RRSP if you're planning ahead. We have a video talking about why using an RRSP before retiring is actually beneficial even if you already have a lot. You can then transition your non-registered assets into a joint non-registered account going forward. Again, that requires a lot of thinking ahead, but if all of it was taxable under your name, all the investment income on the non-registered account is taxable under your name, that could actually screw up your income declaration. I'll have a more detailed video talking about income splitting right here or in the links below. Tip number 2, be careful of capital gains. If you sell something that's increased in value, like a rental property in Toronto, like you could have had a condo there and it would be worth so much more than when you first bought it. And I'm talking about rentals specifically because your primary residence doesn't run into this issue. But let's go through this example. Let's say you have a rental property in Toronto and you sold that. You would have to include half of that profit that you made from the increase, right? Like from the gain, and you report that into your taxes. Let's say you bought that property 20 years ago for $600,000 and it's now worth $1.3 million. That means you made $700,000. When it comes to taxes, you need to report $350,000 of that. Only half is reported as a taxable capital gain. It's a good profit, but if you and your spouse, even if you split it together, that's still about $175,000 as an extra reported income. This increase in reported income could mean you get less or no OAS at all. It potentially eliminates all of your old age security. So you have to be careful. If you have a lot of investments outside of your retirement accounts like RRSPs, RIFs, and TFSAs, if you have non-registered investments or in your plain margin account, maybe that's an easier way to put it, in your cash account and the values increased, if you sell those assets, you might be in this situation. So handling these gains before you start receiving your old age security can help avoid this issue. Tip number 3, plan your big ticket expenses, and potentially withdraw the funds before you're 65. Now, only investment income affects your OAS eligibility, not your cash withdrawals from a savings account. So if you know that you need a down payment for a retirement condo, for example, when you get to 65, instead of withdrawing and selling your investments at that time, it may make sense to cash out some of your funds and some of your investments a year or two sooner. This also helps with risk management. It ensures that your funds are not subjected to market fluctuations right when you need it, or maybe even as simple as initiating the purchase before you retire. A big caveat here is that if you're already in a really high tax bracket, it may not make sense to realize additional gains while you're working just to save some OAS clawback dollars. Tip number 4, use your RRSP early. Think about using your RRSP money sooner than later, maybe even when you're 60 to 65 years old. It may feel strange because you're used to saving for as long as you can. And this is a big shift. We work with retirees specifically that are in this transitionary phase. All the advice that you've received for the last 30 years has been to accumulate and to save as much money as possible. So you need some guidance in the decumulation. We've seen a lot of people, and a lot of them have hundreds of thousands of dollars in their RRSPs with the hope, with the aim for a good retirement. And then we come up with a plan suggesting they take out $50,000 more sometimes than they need from their RRSPs, and they see it as a surprise. Because, right, like you think about it, you've saved for so long and your goal was to never touch these RRSPs, and all of a sudden, we potentially tell you to take out more than you need to spend. But the thing is, if in some cases, if you wait too long and you don't use your RRSPs soon enough, or you don't decumulate, or you don't draw down significantly, and you don't draw down with a strategy, your RRSP will eventually be converted into RIFs. It could cause problems later in retirement where you're forced with mandatory withdrawals later when the money is larger. You might even have to take money out, even if you don't need it at that point, and you don't have that control. We have control before it becomes a RIF. This could not only cause you to lose some of the government benefits like the OAS that we're talking about here, but it could potentially increase your tax owing over your lifetime. This is specifically important if you've passed away without a spouse. The RRSP or the RIF, whatever the form is at that time, if you passed, all of that gets added and it gets declared on your final tax bill. It's like drawing your RRSP all at once, something that is obviously not recommended. So taking some of your money out of RRSPs earlier can actually avoid these issues. Financial experts call this a systematic RRSP meltdown, and it can actually save you significant amounts of taxes, and it's worth having a conversation about with a financial planner. If you have hundreds of thousands of dollars in RRSPs, that's locked pre-tax money. We can help you pay less in taxes by having a strategy to deal with that. If that's appealing to you, check the links below. Tip number 5, think about timing your CPP. Think about when you start getting your Canada Pension Plan. You don't have to start getting your CPP and old age security at the same time. If you start taking your CPP early, you might get less money each month, but it could actually help lower your total income overall. On the other hand, waiting a little bit longer allows more money to be withdrawn from your pre-tax accounts. So it's planning for your whole retirement. It's the whole money plan in your retirement, not just a single year and not just for one item. By waiting a bit to start your CPP, you can use more of your RRSP money. You can potentially pay less tax over time. Imagine your retirement as a big pie. You can cut that pie into 4, 5, or 6 different pieces as your income sources and other savings. So each year, you could potentially take different portions of income from different sources, from different accounts. And creating that blend by deferring your CPP or deciding when to take the CPP could potentially reduce your OAS. Tip number 6. If you have too much income this year and you're retiring, maybe it makes sense to defer OAS and don't take it until next year. Now, as discussed in points 2, 4, and 5, you can free up money from your RRSP from 65 to 70. You can plan on drawing more capital. You can plan on your big ticket items before you need to make the withdrawals for the OAS. Another benefit of doing this is the deferral of the OAS actually increases an inflation-adjusted guaranteed income throughout your retirement. By increasing your OAS, there's simply more dollars to claw back before you lose it all. Therefore, the threshold before your benefits totally goes away actually increases over time. So waiting a bit longer to start your OAS can mean you can get more money over time. This can be a smart move for your retirement income. Tip number 7, don't you forget about the tax-free savings account, the TFSA. So the money that you take out of the TFSA is not taxed, which means you can use this money for your needs without affecting or risking the old age security benefit. It's important to remember that the money you spend isn't counted, right? It doesn't count for that income threshold. If you have space to put money in your TFSA and you own investments that aren't registered, you might want to sell some of these investments, take that profit, take that gain now, and move the funds, move the proceeds into the TFSA. This strategy can lower your total tax over time. And there's also times when it's smart to take money out of an RRSP early. I mean, we keep talking about that. And then putting that into the TFSA if you have room, even if you don't need it right away. If you find yourself in this situation with extra unused TFSA room, you can transfer excess cash, non-registered or registered, you just have to pay the taxes first, and put that into the TFSA. Every year, you're allowed to add $7,000 into the TFSA if you're maxed out right now, and that annual limit goes up by $500 depending on inflation adjustments. That's a wrap on the basic tips. This applies to majority of you that are watching. However, depending on your personal circumstances, such as being a business owner, for example, or having wealth over $1 or $2 million, and you still want to get the most out of the OAS, we can help. We have a free resource that talks about the more esoteric options about dealing with this. You can see that in retirementlaunch.com. That's a free guide that covers the 10 tips instead of just the 7 that we discussed. It includes more advanced OAS clawback tactics, all for free. Or you can just consult with me directly through the links below. Remember, knowing how much money you'll need and planning ahead is super important. It doesn't matter what strategy we approach with if we don't know what you're really trying to get out of your own retirement. It's very difficult for me or anybody else to get a plan going for you and for you to embrace retirement with confidence and clarity. So if you have any questions and feel like you need help planning and even just getting clarity about what you're hoping to accomplish, reach out. Don't forget to like and subscribe. We keep making more tips like this every single week. Enjoy your retirement. Happy planning. Bye.